Welcome to Module 2 of Week 3, and this is probably the toughest module in the whole course, and please bear with us. I hope you have a pencil and paper available or your uh, computer so that you can take notes. Transactions within 3 years of death that are included in gross estate. Now, historically, all transactions that were gifts within 3 years of the date of death were included in the gross estate. However, under the laws we have today in this country, it's only certain transactions within 3 years of death. And believe me, that is very confusing for most students. And I would say there's a lot of errors made on it in the tax exams that you're going to be doing in this particular class for week 3's quiz and week 4. Also, you're going to find that it's a problem for people doing the CFP exam, and unfortunately, it's also a problem many times for people preparing the tax returns. So let's go over those items that are gifted within 3 years or performed within 3 years of death. That will impact you because it's going to be added to the gross estate. First one, and the easy one, is gift taxes paid within 3 years of date of death. And that is literally 3 years, so you go with the date of death back 3 years, and if there's any gift taxes paid, that is added to the gross estate. The concept being that we're going to make it equal to the taxation had it not been gifted, and therefore it's taxed at a higher rate. The reason is gift taxes do not have taxes on the taxes. The gift tax only has tax on the gift, whereas state tax has tax on the bequest and on the tax. Therefore, it's a higher tax, and the way you would make a gift tax equal to an estate tax would be to add the tax on the gift tax to what's being taxed, and that's exactly what this one does. And it's 3 years, so we have to go back to the specific date. So if it's April 21st, you go back to April 21st 3 years ago. Any gift taxes paid during that period. Gifts of life insurance by the testator on the testator's life. Now that gets confusing for people because people just assume any life insurance policy gifted within 3 years of death, and that's not true. It's only those policies on the testator's life that have been gifted by the testator. And I'm not sure how to get the point across on that. I find every class I teach, there's a number of students who never seem to get the concept. They either want to tax all life insurance as transferred by the testator, or they ignore it completely. The third is transfer of retained items. A retained life estate. If you retain a life estate and you die, that is going to go into your estate. Transfers any powers to alter, amend, or revoke. Any could be a power, could be a trust or whatever, but if you can alter, amend, or revoke the instrument, that will be included in your estate. Again, if it's done within 3 years of death. A retained reversionary interest that can occur within 3 years of death. And that is a trick one many times on a quiz or a CFP exam, because it'll say John gave Mary a life estate in the house. Well, by not naming who the future interest is, that makes it a reversion, and therefore that reversion will be included in the estate. And the transfer you can only enjoy or use at the decedent's death. So if I cannot get access to something until I die, or you cannot get access to something until I die, that would be included in the estate of me. So again, these are not simple to see many times. You're not going to see them calling out the word that they're going to be able to alter the trust. It'll maybe talk about the fact that they can add people to the trust, or maybe they can alter the, I'm sorry, they probably use the word, change the investments or control the investments. Those are all powers that are going to be taxable and included in the gross estate. Life insurance in the state, and this is the rules, and we'll go slowly through this because it is complicated. It will be in the estate if the proceeds go to the state, and that's, for example, if I make out a policy for Lee Shu and make Lee Shu's estate beneficiary, or my executor the beneficiary, any rights of ownership, and that is interpreted very broadly, rights to name or change a beneficiary, right to surrender a policy, right to dividends, right to borrow on the cash surrender value, right to pledge the policy, right to revoke any assignment to the policy, and if payable to estate, even if no incidence of ownership. So if someone else buys a policy on me and the benefits go to my estate, it's going to be included in my estate even though I did not have a right of ownership myself. Now, a good way of thinking of this is life insurance on the life of the decedent with anything other than the straight vanilla passing it on to somebody else as ownership is going to be included in the estate. And the key is the ownership in many cases that students miss. So if I own a policy and make my son the beneficiary, I still own the policy. I have to gift the policy to my son and then live for 3 years after I gift it. Again, complicated. Reversionary interest. We mentioned that before. A reversionary interest typically shows up where you make a life interest to somebody or a term interest to somebody and then don't list a future interest. That makes it a reversionary interest. It's a 5% rule in this, but as a practical matter, especially if we're talking about real world, any reversionary interest is going to wind up in the estate. And it also includes gifts where enjoyment is conditioned on the donee surviving the decedent. So again, it might be that I have a car which I give to my daughter as long as she survives me. If she doesn't survive me, it goes to my son. That would be an example of a surviving decedent. Again, if it was I gave an example which would make it a outside the estate, but if we want to make it so there could be a state issue, I give my car to my daughter so long as she's alive when I die. That would be a very obvious one. That would be a reversionary interest because there's no other person who's listed as a reversionary, which I gave before as my son. Retain interest or control. Transfer retained right to income for life. And this is, again, if I have a life estate, that's going to be included in my estate. I have retained rights exercisable only with consent of another. That would be included in my estate. A retained voting rights to closely held company. Retained power to change trustee. A retained or impose on the donee the responsibility to use assets to discharge, transfer his legal obligations. And the way I'd put it, the easy way to remember is if you have a right or an interest or you have some type of control on the assets, it's going to be included in your estate. And we listed specific items here, but if you just think about a client having maybe the right to change a beneficiary or the right to determine if the value should be changed or if it can be sold, automatically it's going to be included in the estate. I guess where decedent retain powers, and the three choices here are to alter, to amend or revoke any trust, contract, deed, or other indication of ownership or control. And this many times could have been done 20 years ago, and I might note that that 3-year rule only applied to the items we talked about earlier. And when you give up the right, here it's when you had the right, and let's say we had the right that we set up in 1988 to alter the will or alter the deed or the trust, whatever, and we made a gift of it, that would affect us even today unless we give up that right to change, alter, revoke. Annuities, joint and survivable annuities that are owned by the decedent, for example, pension plans. And this could be with a spouse, and it usually is a pension plan for purpose of exams, that John worked for a company and had a pension plan, and the pension plan consisted of a joint and survivor annuity. He died. Well, that part of the plan that was associated with the surviving to his spouse would be included in his estate. Likewise, if he was not married and it was his daughter or his son, or maybe his daughter and son, that would be the survivors, depending on the type of policy and the number of survivors he could have. Again, anything that was related to son and daughter still alive when he died would be included in the estate. Next is present value. The proceeds going to surviving parties will be included in the estate, and it's the present value. And you have to use the IRS tax tables, and there they show you what the interest rates are to use for making the calculation. And it varies. Some of these rates change monthly, some quarterly, some annually. Right now, the rates are still relatively low, so it's not a big deal for the calculations. As far as being easy, it's the money that you're going to have to pay in taxes. The one that we mentioned back in week 2, the general power appointment, if it's in the estate, it's going to be part of the estate unless there was an ascertainable standard or a 5x5 power. And then the one that's missed probably the most is subject to concurrence by an adverse party or the grantor. We talked about this in week 2, and I think that most of you probably have a pretty good understanding of it. I think that where it will be a problem is when you don't see the word GPA mentioned. It's just going to tell you that Bob is trustee of a trust set up by his father for the benefit of the family, and that's where you're going to run into a problem. Joint tenants' right of survivorship. And again, hopefully this is only going to be with spouses. If it's with non-spouses, it's probably a bad decision, but property held in joint tenancy with the rights of survivorship will be included in the estate at the fair market value of death. So the assumption is joint tenancy property is fair market death of the entire property. The exception is if the only joint tenant was a spouse. So if my spouse is the only survivor who's in the joint tenancy and we got the joint tenancy between just the two of us, then only half goes into my estate because the other half was a spouse, the special will, or the surviving joint tenants can prove their contribution. And that is very difficult to do. People, for some reason, just don't keep the kind of records they should, and therefore it's hard to prove this. This is where you start seeing forensic accountants who have a digging through paperwork and through all sorts of paperwork. I don't even understand half of what they do, trying to find proof that some payment was made by somebody else. Transfers due to state statutes. This is going back to, again, week 2. I might note that once you start something in this class, it's going to be with you all the way through. So if you miss a week or you don't understand the material a week, it's going to suffer later on because it just keeps showing up. But all of these common transfers in common law states are going to be included in the gross estate. And that sort of summarizes where we are and what we're doing as far as trying to have you understand the gross estate, because we've covered what the gross estate is in this last few minutes. We will now go on to some other key areas of estate taxation when you go to Module 3.